Well, thank you very much to everybody for joining us for this session. This session is the Central Bank's CP86 Dear Chair letter. What direction does it point, and should we be worried? So, looking at the letter which came out at the end of October, it very much is a culmination of the work that was undertaken by the Central Bank of Ireland in the period from June 2019 until October. So we're talking about 14 months, where they would have conducted a number of inspections, both at desktop and on-site, to various different fund management companies and SMICs within the Irish regime. So there are a lot of things to digest from that, and issues that boards and various different fund management companies should be looking at. So I'm joined by Cillian Bredin here, and I suppose Cillian, looking at the fund management company guidance, the letter that came out, and given the buzz around the findings from the thematic inspection, what are the three kind of top things that clients are paying attention to most now?
Thanks, Shane, and hello, everybody. So the top three things, well, firstly, I would say substance is a main issue that people are discussing now. Obviously, we anticipated that this will be looked at as part of the CP86 review, and the findings certainly haven't disappointed in that respect. You know, whether it's the requirement to have 3 full-time employees or equivalent, which seems to be the minimum expectation of the Central Bank of Ireland, or the move towards more locally based designated persons. That seems to be the topic on most people's top three. Naturally, this will likely be a bigger issue for self-managed investment companies, SMICs, and maybe smaller legacy mancos that have lower numbers of staff. The other item on people's list is likely to be the enhanced role, which seems to be being pushed out for the organisational effectiveness, or OE directors. As listeners will be aware, the initial guidance was more broad in its terms and short, really, and allowed for quite a bit of flexibility in how the role was fulfilled. But I think from the outset, that was probably always going to be expanded upon, and it has been in this Dear Chair letter. So this letter is very clear in its expectations, for the OE director, that they should illustrate and, importantly, be able to evidence independent challenge of existing practices, things like the challenge of information provided by designated persons and any delegates that are appointed, the enhanced role in considering conflicts of interest which may arise, and also, importantly, the onus on the OE director in relation to changes to the resourcing model that's adopted by the management company. The third topic that's probably been most discussed since the letter was issued is probably the director rotation and the need for greater diversity at board level. And we would expect that clients are currently looking at the composition and tenure of their boards to assess where changes need to be made in that regard, if any.
Yeah, I think certainly they will be the topics that I would have heard, certainly in the market, come to the fore. The OE director and having support for the OE director and providing the relevant resources to enable that individual to undertake the role in a more focused manner is definitely something that's coming. I think that's welcomed from those who are undertaking the role. Looking at the CP86 letter and I suppose being cognizant of the ESMA input into the European Commission's review of AIFMD and the consultation paper itself that was issued by the European Commission, is there a direction of travel emerging from the findings of the CP86 letter and more broadly in the European market?
I think so, Shane. Yeah, I mean, it's clear that the central bank is looking to align with the broader regulatory position in Europe, and as we know, the enhanced regulatory convergence throughout Europe. And there have been a number of points which have come from the thematic review, which were previously included in ESMA papers or in speeches and press releases by the central bank. For example, the ESMA investment opinion in July of 2017 in relation to 3 full-time employees. So I suppose one key point to remember in all of this is that the reason for introducing CP86 and the related guidance, obviously, is to protect investors by enhancing the effectiveness of management companies, but also, I would say and argue that it's to protect the delegated model structure to ensure that the management company model is as robust as it should be, and that it can stand up to scrutiny from a European perspective. So I think this is a key message which can sometimes get lost when we're looking at some of the individual issues that are raised as part of the review. But Of course, substance, as I mentioned, that was outlined in the ESMA opinion, and the need for greater diversity at board level has been flagged a number of times by the central bank. Time commitments, again, that's another issue which is being honed in on, and again is linked to substance. And this is something that we've seen be an area of focus for the central bank, at least over the last 18 months. And as listeners will probably be aware, there is enhanced scrutiny of new director and designated person applications being made to the fitness and probity section of the Central Bank of Ireland, and we've seen significant increases in time commitments required in a large number of cases. I suppose another point from that perspective is that since the introduction of the management company guidance, we have seen a marked reduction in the number of self-managed funds, or SMICs, which have been authorised. Now, I don't think this is to say that that model is no longer viable, but certainly the direction of travel appears to be moving to a more managed solution for investment funds. And I don't think that the Dear Chair letter has done anything to change the direction of that travel.
I'd certainly echo that. I think we've seen in other European jurisdictions that the managed platform or managed fund is the more popular route that seems to be appearing throughout Europe. So certainly that seems to be echoed by the central bank's review and findings. In the letter itself, it talks about the Central Bank of Ireland issuing risk mitigation programs to various different fund management companies that are out there in the industry. If you don't receive a risk mitigation program, should you still be concerned? Should you be taking action?
You should certainly be taking action. I don't know if I'd say you should be concerned, but the central bank will expect you to take positive action on foot of this Dear Chair letter, and we will be advising clients, to take this very seriously and address any perceived deficiencies as soon as they can, in advance of Q1 2021. On the basis the central bank has noted that this is an ongoing process. Now, for those who have received a risk mitigation program, I would say the key here really is to engage early and to take decisive action quickly. I understand that this will be discussed in greater detail on day 4 with my colleague Muireann Reedy, who will be on a panel giving tips on how best to approach the situation of an RMP if that arises for you. In that vein, I would expect that an indication as to what might be contained in the RMP may be given as part of the on-site review, for example. So it may be the case that some of those issues have already been addressed by the time that RMP is issued, but certainly even in that case, I would say timely communication with the central bank is vital because as you might expect, regulators don't look too kindly upon their recommendations not having been acted upon, and it's at that stage that recommendation could potentially move in a more serious direction.
Yeah, I think certainly early engagement is the key message that I'm hearing there, and engaging actively in the process is important for all members of the industry, regardless of whether a risk mitigation program is issued or not. So just moving on from that, what do firms need to do now? So what do they need to have in place before the end of March 2021?
Sure. So, it'll depend obviously on the type of firm, whether they're a new entrant to the market, whether they're a SMIC, whether they're a smaller legacy Manco, and obviously whether or not they've received a risk mitigation program where those deficiencies will have been identified by the central bank or highlighted to them. Broadly speaking, what we would be saying to clients is to take stock basically of where you are, look at doing a gap analysis of your current setup and the key outcomes referenced in the letter. Basically considering enhancements that can be made to the current process and looking at focusing on the topics listed in the letter. So topics like time commitments, skills and expertise available to the management company in discharging their obligations, things like functions and tasks which have been retained by the management company or delegated to third parties. Obviously, one of the key areas of focus will be looking at resources and the operational capacity of the management company to make sure that you are able to do what you need to do from a resources point of view. Then I think once you've done that groundwork, it is important to take the opportunity before March 2021 to consider an action plan which should be put in place, and in that action plan, identify definitive timeframes in which the various actions should be completed.
Yeah, I think it's important to note there that newer Mancos, those that would have been authorised in the last 18 months, certainly would have a smaller road to travel to meet the expectations that have arisen from this letter. And there may be more work that needs to be engaged in by those who are as we call them, legacy mancos or SMICs, to ensure that everything is running smoothly. But I suppose really that's great up to March 2021. I have my action plan. I've discussed it at board level, but when should the action plan be fully executed? So when should it really be moving?
Yeah, I mean, again, it will depend on what's on that action plan, what deficiencies, need to be addressed, because obviously different points will have different time horizons. As I mentioned, we should be looking at it now, looking at your processes now, putting that gap, or carrying out that gap analysis and putting the action plan in place. That should be done by March 2021. I think at that stage, you will also have the time frames of when you intend to action those particular points. Obviously, the sooner the better, provided that it's not going to negatively impact whatever the action might be. But certainly over the course of 2021, I would expect that some, if not all, of those actions should be completed. As I mentioned, the central bank is looking at this on an ongoing basis, so they will be checking again, if you like, to make sure that some steps have been taken. But really, in the course of 2021, I would expect those actions have been executed.
Yeah, that's great. And I suppose looking at the letter, there are certain aspects of the fund management company guidance which apply not only to the fund management company but to externally managed boards. And it should be borne in mind when you are on an externally managed fund board that you still need to comply with certain aspects. So, board composition, diversity, and looking at the independence of the directors that are there. So I suppose the independence of directors was specifically flagged in the letter, and the term of appointment was coming under scrutiny. Could this result in a higher turnover of experienced directors? And is there a pool of directors out there in the Irish market that are strong enough to undertake these roles?
I certainly think there's a strong enough pool in the market that can, carry on the role of an experienced director. And while there may be some degree of turnover as a result of the comments made by the central bank within the Dear Chair letter in terms of independence and tenure, I don't think it's necessarily going to be a free-for-all from that perspective. I do think that clients, as well as the directors themselves, will be looking at the portfolios and the tenure, as I said, and composition of their board members, and assessing whether any changes need to be made, whether that means a change requiring a rotation of an existing director off a board, or maybe adding other directors from a balance point of view, for example, the gender point that was raised by the central bank. So certainly more movement over the next while than maybe might have been anticipated as a result of these particular comments. But from a corporate governance code perspective, I suppose it does make sense. It follows what's in place, for MiFID firms in terms of looking at the length of service of directors and any impact on independence, and also I believe what goes on in the UK from a corporate governance code point of view. So it does make sense, and certainly will, I would expect, to open up the market to some new entrants in the director space in the coming years. Obviously, experience is very important, and when things are not going as well as you might like, it is important to have that experience on the board. So that should also be considered by clients and from boards who are looking at their composition as a result of the comments raised by the central bank in the Dear Chair letter.
I think it's certainly worthwhile noting that a lot of this comes down to good corporate governance, and given the focus on ESG, the disclosure regulation, which will be implemented in March of next year, certainly these are things that boards should be looking at, should be considering, and working together to make sure that they're at the forefront of everything. Now, before we move to the live Q&A session, which is kind of up just now, from this session, Cillian, if there was one thing you were going to say, is a key takeaway for those here and attending, what would that be? Would it be early engagement? Would it be looking at the action plan? What would you say? Don't delay, do now.
Yeah, you took the words right out of my mouth, Shane. I mean, I think early engagement is important. Early board engagement is important. I think including this on your Q4 board meeting agenda for management companies, having maybe a working group at the level of the management company to go through that gap analysis and identify an action plan and discuss it with the board in terms of, areas of concern, and identify when you think changes need to be made and what changes need to be made. But certainly early engagement and putting in place that action plan is a key step at this stage.
Okay, well, perfect. Thank you very much for joining me, Cillian. And as we move into the Q&A, welcome questions from those who are participating. Thank you very much.